What is an index fund? When you start investing in the stock market for the first time, the thought of having to choose your own investments can be enough to discourage anyone from getting started. But what if you could invest in the entire stock market? That's where index funds come in. Index funds are a type of investment vehicle that have become increasingly popular in recent years. In fact, the Wall Street Journal went so far as to declare index funds the new kings of Wall Street in one 2019 headline. Investors love index funds as a cost-efficient way to build wealth with a proven track record over the years. So, what exactly are index funds and how can you get started investing for retirement? In this video, we are going to explain what index funds are, how they work, and why you may want them in your portfolio. In the financial world, an index is a measurement of the performance of a group of underlying securities. An index typically tracks a particular sample of the market. You may have heard of the S&P 500 and the Dow Jones Industrial Average, as those are two of the most popular indexes. The S&P 500 is a market index made up of 500 of the largest companies in the stock market. The Dow Jones Industrial Average is an index that tracks 30 of the largest and most traded blue-chip companies in the market. Index funds give you broad exposure to large segments of the entire stock market with a single fund. They tend to be low cost and help you diversify your investment across multiple assets within your portfolio. That means your money isn't tied to one single stock, which helps protect you from any downturn in the market. Index funds track a specific index, and there are many different types of index funds. Depending on the index fund, your investments can be automatically organized across different types of stocks, bonds, or other asset classes. How do index funds work? The goal of an index fund is to match the market, not beat it. In the case of an S&P 500 index fund, the goal is to achieve returns identical to that of the S&P 500. When an individual invests in an index fund, they essentially invest in every security that makes up the underlying index. You can get started investing in index funds pretty quickly. Keep in mind though that the name of this game is long term, so it's best if you get started early and plan to keep your investments for a long time. First, pick an index. If you're just starting out, a broad-based index fund, like the S&P 500 or a total market fund, is a good place to start. Look for index funds that have the lowest fees, also known as expense ratios. For example, Fidelity has a 500 index fund with a 0.02% expense ratio. Then you need to buy shares. You can invest in index funds through taxable brokerage accounts like Fidelity or Vanguard. Or you can invest through your retirement accounts like a 401k or a traditional or Roth IRA. Once you buy shares, be sure to continue to invest every month. Even though index funds are great to set and forget, continuing to invest in them is key. Be sure to figure out your investment goal and continue to invest that much every month. A compound interest calculator can help you project earnings over time. You can use this calculator to figure out how much you need to deposit over a specific period of time to meet your goal. For example, if you deposited $10,000 into an investment account and that investment grew an average 7% for the year, you will have made $700. After 30 years and a 7% return, you will have made $76,000. Compound interest is the secret sauce in investing. Passive investing. Index investors don't need to actively manage the stocks and bonds investment as closely since the fund is just copying a particular index. This is why index funds are known as passive investing, and it's what sets them apart from mutual funds. Mutual funds are actively managed by fund managers who choose your investments. The goal with mutual funds is to beat the market, while the goal with index funds is simply to match the market's performance. Since index funds don't require daily human management, they have lower management costs than mutual funds. The money saved in fees by investing in an index fund over a mutual fund can save you lots of money in the long term and in turn help you make more money. A common strategy for many investors who have a long investment timeline is to regularly invest money into an S&P 500 index fund and watch their money grow over time. That wraps up the video. I hope you enjoyed it, and if you did, make sure to give it a thumbs up. Subscribe to our channel and don't forget to press the bell icon to stay notified about our uploads.